what are some of the things that a business owner should think through before making that choice of entity?
Yeah. So when they're starting, like just at kind of at the jump, I mean, it's what you're saying is the very common situation is, hey, I don't need to go spend, $5,000 to get all these documents in place. Like I'm getting started. I don't even need to go on whatever the website is to get all this stuff done for cheaper. I just want to run and hit the ground running. And then, usually there's a point where you realize things have kind of taken off with the business, and it's like, okay, the problem then is it's like, okay, we should engage an attorney. We should get this handled, but you're so busy. You're trying to run the business. You don't have time to deal with that. And so, to start off the company, I mean, LLCs, if people assume, well, yeah, you mentioned that as like people think, well, let's just start with an LLC. A lot of times that is a really good way to, just forming a single member LLC. This is the most simple business situation where, hey, I don't want to have to file an additional tax return. I just want to have kind of a liability shield there for me. I got this company, and so I just need an entity there. If something happens with it, they can target that. They go to the company, and there's a separate entity from myself, so it's not me that's on the hook for all this. I've got my entity, and that's a common way to set these up, and it's pretty simple for like a solo proprietor kind of thing. The most simple kind of business that's going to show up on your individual tax return, and all the activity, the income, all that stuff's just going to flow through to you. Doesn't make anything more complicated. But when you get into, commonly you're going to have a business partner, or maybe you're a doctor, and you say, well, yeah, let's set up an entity. Well, it depends on how much money is this entity going to be bringing in, and if you actively participate in the entity, if you work in it, very common structure for doctors is they have like a professional limited liability company, which is just basically fancy limited liability company because you're a doctor. And they make an S corporation election for that. And they do that, for one big reason is the self-employment tax benefit. The way it works out is you wind up paying self-employment tax on a much lower portion of the overall income of the business. So yeah, I think, if you're just getting started, you should at least, do what the lawyers do a lot of times is at least, Google some things, and and then depending on how complex it is, you might need to get a professional involved.
Well, you mentioned paying a little bit less on the self-employment side. I don't know if you've been following recent legislation in Congress, but they're trying to get after the business owners.
Right.
And last I heard this morning that seems to have stalled.
Yeah.
Speaking of which, obviously, from a business owner's perspective, minimizing the taxes while we're operating is huge.
Huge.
And so one area where there's overlap between saving taxes and doing good for the business is there are things that a business owner could do to attract talent, right, where there's a tax benefit for that.
Yeah.
There's certain things that they could do for employee benefits that could help them with tax drag.
Right.
When a business owner is thinking about tax efficiency, and they're also looking at the needs of the business, and we talked about don't let the tax tail wag the investment dog.
Right.
How does a business owner go about evaluating the pros and cons, the benefits of implementing such plans for tax savings, coupled that with ultimately, hey, one day I'm going to sell this business?
Right. Yeah. That's a big question. What we'll often encounter, you were talking about kind of incentivizing employees, which, it'll be like a business owner means well. They have like an employee that's doing an awesome job. Maybe they've been with them the entire time. They're not actually an owner, but they're like an owner. They treat it's their baby too. Or they just want to, maybe they want to attract some really key talent to the company. A lot of times people will think, well, I'm just gonna give this person some ownership in the company. I'm just gonna go ahead and just give this to them, like, because they earned it, or maybe they didn't earn it, but I want them to be in the company with me. And we'll say, that's a great idea. It's a great sentiment, but there's a lot of unintended consequences, particularly tax consequences where, it's like, okay, I'm going to give you 20% of this company. Well, all of a sudden, there's going to have to be taxes. If the company's worth $1 million and you just give someone 20% of the company, I mean, was that a gift? Are there gift taxes associated with that? Or is that ordinary income to this employee? I mean, there are things like that you want to think through. And so there's ways to structure it so that doesn't happen. So kind of, maybe you have someone that, hey, if we sell this company, I want them to be able to participate in the sale. Like, when we go to sell this thing, I want you to get 25% of the proceeds. Well, you don't just give them 25% of the company. You can issue a thing that's called like a profits interest for tax, which is, it basically is a way to do that, but not trigger these negative tax consequences. And so that's one of the areas, one of the things you can do.
Okay. Well, speaking of unintended consequences,
yeah,
I want to ask Jack's opinion on this. We talked about, you talked about doing the single member LLC for most people that they start not to do it, but they often do it.
Yeah.
And obviously, there's some pros and cons there,
right.
Gray area with asset protection.
Right.
But one of the things that always seems to come up is these companies that have grown, corporate governance seems to be lacking.
Right.
And whenever there's a dispute later on, now it's a he said, she said situation. So, Jack, I wanted to get your opinion when you're working on deals. And I know you guys are always asking, okay, let me see the meeting minutes. Let me see the corporate documents.
Right,
and then the first question out of their mouth is, what's a meeting minute?
Right?
Yeah. Right.
So talk to me about, corporate corporate cleanup, so to speak, things that need to be handled before you go into this negotiation to exit, because you want to limit the cost, you want to make it efficient, you want to take care of it amongst yourselves, but what are some of these issues if they're overlooked for too long that could create problems when it comes time to exit?
Sure. I mean, what we found, especially I think as LLCs have kind of become the most common way of forming an entity, we've generally found that people just file what they need to file with LLC to open, maybe through LegalZoom or just kind of reading some stuff online, and that's all they do. What they don't kind of understand is really for an LLC, and other companies, the only thing you submit reflecting kind of the ownership or anything related to the company to the government is through the IRS. A lot of states have policies where they try to allow people to keep ownership information and other things private. So we might get a situation where all they filed is what they need to file with the state. Maybe they filed some tax returns, and now we have to go in and back up kind of what they've agreed to. Now, sometimes maybe they hire a lawyer and everything goes well and they form it correctly, but that's the last time they ever look at it. They throw it in the back of their closet or a filing cabinet, and they don't have all the minutes and other things that they need to have that we would like to see when they close. Sometimes it's a big deal. Sometimes it's not. If everybody's getting along in the company and the ownership and that, there really wasn't anything exciting that went on during that time, maybe we could come back and look at tax returns and do some cleanup work. But it's a risk. There's an exposure there that if you don't have your issues in order, the buyer might take issue with that. The buyer is going to require you to make some representations and warranties around the ownership of the company that you'll have to make. And if you can't make them, or the buyer isn't comfortable with the diligence, all of a sudden you might go from a stock deal, which as a seller you usually like, and it might get thrown into an asset deal, which is going to change the economics of what you might receive in the deal. And what I mean by a stock deal is it's rather you're transferring just the ownership of interest of the company to an asset deal where you're just selling the assets of the company. And Michael knows more about the tax implications than that, but generally as a seller, you want to be selling the stock or ownership interest in your company. And so having that in order, having an attorney check in on that, whether maybe you don't want to do it every year, although it's a pretty, maybe you're spending a couple $100 a year, but having somebody kind of check on that stuff, make sure it's up to date on an ongoing basis, is you're going to put yourself in a better position to focus on what you need to focus on to close your deal.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.